All right, welcome back to Two Stupid Guys Trade Stocks. I'm Vinny,
I'm Dylan.
and today I got a kind of a fun one. Dylan and I are talking about options trading. Dylan's been trading a little bit more in terms of options, but he hadn't discovered credit spreads yet. So I wanted to talk to him a little bit about that and see, maybe it's something he can incorporate into his own strategy and make it a little bit more enjoyable experience from trading options.
Yes, so I do not know. I've never done credit spreads. I don't know what this is.
Yeah. It's kind of cool. Like, if you've seen our options trading, like our stimulus check challenge videos, I am using kind of an option spread technique. It's a little bit of a different one, but we're going to talk about that briefly here. So option spreads basically at the very core is about selling one option and buying another option. It's two paired options is what a spread is all about. These are a few different kinds of option spreads you can trade. This is the one I'm using in my stimulus check challenge video, and also we did a separate video on the poor man's covered call. It's considered a long call diagonal debit spread, so it's a little fancy name there. But don't get intimidated by that. Each word, if you break it down, kind of means something, and then you can kind of figure out what it means from there. But I'm basically going to talk to Dylan today about a bull call spread.
I like that poor man's covered call is a much better name.
Yeah, it is definitely a much better name. I would agree entirely. So like I said, the basic structure here is you're buying one call and then you're selling another call. When you're doing a bull call spread, you're buying one call, close to the money or at the money basically usually, and then you're selling one at a higher strike price. So this gives the stock room to go up and you to profit. This is something Dylan could employ when he thinks a stock is set up for a swing trade. It's bouncing off a line of resistance and he thinks it's going to trend back higher. This would be a great play at that point in time.
So do I have to, I just have to have 100 shares and then buy a call contract?
You don't have to have 100 shares. You just buy a call contract and then sell a call contract. The one you bought is collateral.
You can leverage you can use the collateral for the one contract. Oh,
yeah.
Okay.
You don't have to own any of the underlying shares. The long call is your collateral for your short call.
Okay.
Yeah.
Got it.
So, if you're into profit and loss graphs, this is kind of what it looks like. There'll be a range between the long call and the short call price where your profit is kind of changing depending on where in that range it is. Obviously, closer to the short call price, but not hitting it is your maximum profit potential. And the way these things tail off here at the end and they're flat is because it's a defined risk strategy. Sounds fancy, doesn't it? Defined risk strategy just means that how much money you have in the line. There are some very rare, unusual circumstances where you can kind of get outside of this, but for the most part, as long as you're not carrying these things into expiration, you should be okay. So I'm going to use an example here with Palantir, one of Dylan's near and dear long-term stock positions here. So Palantir, as of filming this video, is closed at $24.67 a share. So I looked at the September strikes. You want to give it a little bit of time so that way you're not getting eaten by time decay very, very quickly. But so September from right now, we're doing this in June, is about 3 months away. So a little bit of time, a fair amount. I priced this out with the $25 call, basically at the money or very close to the money. You're going to pay $274 a share for that right now. So $274 to give you one call contract. Against that, you can sell the same dated $30 call and collect $129 back in premium, right? So now this is how the trade looks. We have that $274 we paid minus the $129 we received. So we're $145 out of pocket to put this trade on per contract, right? The difference, the potential profit here is the difference between the two strike prices, 25 and $5 times 100 because it's an option, $500 minus the $145 we're out of pocket. So our maximum profit on this is $355, and maximum loss is $145. You can also calculate the break-even price here, which is just the low strike plus the premium paid out of pocket, which is that $1.45 a share. So $26.45 a share was premium out of pocket.
So
2-to-1 risk.
It limits your downside.
Exactly. Yeah. It helps you because if you just bought a long call, right? All $274 would have been downside potential, right? You could have lost
and if that tank, because a lot of times with swing trading, you can find a beautiful setup, and then if the overall market goes down, it wasn't even the stock's fault or your fault. It just happens. So
Yeah.
this limits that, so it caps the gains, limits the risk, but it's still well over 2-to-1. It's like
Yeah.
2.4.
Yeah. Something like that. Yeah. I didn't do that differential math, but yeah, yeah, it is probably about that. 2.4 is probably about 2.4 to 1 risk ratio there. I got another one for you here, Dylan. Another example. Fubo, your favorite streaming company there. Current share price about $29.79 a share. Nice rebound for you there, Dylan. Cut you
For
off that
9.
bridge.
They're going to be at 60 in no time.
Hey, well, if they're at 60, this is a great options play for you, right? So I gave them a little bit more time because we both know that like the end of the year is a good time for them. You get a lot of subscribers as you move into the fall sports season. Right. So I did the January calls here. So we're looking at the January 21st, 2022 calls for $30 a share, pretty close to at the money. You're going to pay $8.72 a share right now. Pretty hefty premium, right? 872 bucks.
Yeah.
Yeah, pretty substantial. So against that, I decided to go ahead and sell the $45 call. Since the premiums are so rich, you're still getting $5 a share selling a $45 call right now on them. That's pretty impressive.
That is pretty impressive. Yeah.
Yeah, I mean, you might want to start selling some covered calls in the Fubo shares there to help you make a little more money. But the max loss here, we're looking at the $872 you paid out of pocket minus the $510 you collected, so $362 for your max loss. But since the strikes are $15 a share apart from each other, now we have $1,500 maximum minus the $362 we're out of pocket. $1,138 is your maximum profit.
So I wonder, I think like maybe even the farther out you go, the better the risk to reward, because that's a 3-to-1.
Yeah, that's not necessarily the rule. The options premiums on them are
It's just
pretty
Fubo.
high.
Got it. Okay.
Very high implied volatility. That's why. But you are looking at like a 3.5 to 1 risk reward ratio here, which is pretty impressive.
Yeah. The only problem with this strategy is that Fubo is clearly going to go to like $200 a share.
That could.
So...
That could.
This is definitely safer than what I'm doing.
Yeah. I mean, it has trade-offs like everything in life, right? So you're definitely limiting your gains by putting a trade like this on.
Yeah. I can't remember. I had read somewhere that overall, when you look at all the different option strategies, covered calls are usually the most consistent winners, and over time, people become like stability leads to instability, and they buy more ridiculous options. So this is actually kind of awesome. I'm digging this.
Yeah. So I wanted to show you how it kind of looks like when you put this into a trading app. So I pulled this up in Schwab, my favorite trading app. And if you actually put in this position for the Fubo, it'll tell you basically based on the share price where you are at in terms of your profit and loss, and generates this graph to help you kind of understand it. The same profit and loss graph we look at back in the beginning, but it'll make an individualized one for that position.
Yeah, that's pretty awesome.
Yeah, pretty nice.
It's not I have Robinhood, Vinny, so I'm not going to have these cool amenities. Okay, all right, fine. All right. I'm pretty surprised.
I was honestly surprised that they had this as well, but I thought it looked pretty nice. It's even color coded for you, so that way even a simpleton like you can kind of figure out where the green section is.
That was a well-timed slide.
Yeah. Yeah, but no, I think it's a cool strategy to kind of employ along with your call option swing trading strategy. So we'll await that video as well. That's been requested. I know people are anxious to see that one.
That's coming up.
Yeah, but like this is a nice way to augment it. I think you can use this to kind of build upon your strategy that you have already kind of engaged in with the call options.
It definitely answers the biggest problem with my long call strategy is the safety. Because like if I'm wrong, because options are leveraged, I'm wrong. Yeah. So that's a little bit of an issue.
Yeah, nice. I think it gives you a good kind of risk reward ratio for the most part. You lose often and small, but like when you win big enough that it should kind of mitigate that. And, you're still running a 2-to-1 like ratio in terms of your wins to losses, more than that, right?
Yeah, more than that.
So as long as you're, I mean, at that point, it doesn't matter what the risk reward ratio is. Basically, it could actually be like even opposite, and you'd still come out okay because, you're winning most of your trades.
Right. On my swings, we're well over 2 to 1. On
Yeah.
my option swings, I've had like one really bad loss because Peloton gapped down and it ruined all my stats. So I'm gonna have to see how that works.
Oh, Peloton.
Yeah.
All right, guys. Well, thanks for tuning in. We'll catch you in the next one. Let us know if you have any questions about this stuff in the comments below. I know it's kind of a confusing topic a little bit. Okay.
Yeah,
We
we'll
appreciate it.
answer it.
Yeah, do our best. Thanks, guys.